Hello, and welcome to our new investment strategy update. Russia's invasion of Ukraine has created a commodity-driven supply shock that is generating considerable economic and financial uncertainty. It's a new state of play for the world economy. The economic shock that comes from trade, finance, consumer and investor confidence, and energy will weigh on global growth, with the greatest impacts felt in Europe. Russia is becoming isolated from a large part of the world, and pressures on commodities are taking inflation to record levels. While a ceasefire in Ukraine would limit the economic damage, the most likely scenario seems a long conflict within Ukraine borders, keeping up pressures on energy and inflation. In typical economic cycles, a recession would be inevitable. But the strength of the post-pandemic rebound offers some economic buffer. Indeed, the US and Eurozone have been growing significantly faster than average over the past year or more. Job markets, corporate profits, and household savings are all solid, supporting production and consumption. But the balance of growth and inflation will worsen, and much depends on how long the war lasts and policy responses. Central banks are focused on fighting inflation, the Federal Reserve has just started a fast hiking cycle, and the European Central Bank's first rate increase is expected towards year-end. But monetary policy can only do so much faced with an exogenous supply shock. Fiscal spending is the main tool that could really cushion economies. Governments will have to step in with ambitious emergency measures and, crucially, large-scale long-term investments. Let's now hear from Stéphane what this means for our portfolio positioning.
Financial markets have tracked the strategic shift in geopolitical and economic relations, leading investors, including ourselves, to take a more cautious stance. Our current portfolio positioning reflects a prolonged conflict between Russia and Ukraine, which, as we have just heard from Samy, seems to be the most likely scenario. Our exposure to equities is neutral. We have reduced European equities and small-cap stocks as we anticipate them to be the most affected by higher energy and labor costs, as well as longer-lasting supply chain disruptions. We are still underweight fixed income, having tactically increased government bonds and reduced allocation to convertible bonds and emerging market debt. We maintain overweight position in Chinese government debt. We have added to commodities, favoring industrial metals, gold and energy to protect our client portfolios against any escalation of the conflict in Ukraine that will result in higher inflation. We have also increased cash, enabling us to move quickly on potential market corrections. In currencies, we have reduced our exposure to the euro and expect the US dollar and Swiss franc to act as safe havens. For the renminbi, the Chinese economy also faces a commodity shock, but monetary and fiscal authorities remain committed to supporting growth and financial stability. A key factor is China's stance in the Russia-Ukraine conflict. Giving clear support to Russia would have negative effects on Chinese growth, incoming investment flows, and share in global trade, while staying neutral will probably support Chinese economy. The new environment has already reshaped the outlook for a number of sectors. As spending on cybersecurity, clean energy, and defense rises, new long-term investment opportunities are opening up. We continue to monitor risk very carefully and remain prudent and nimble in our portfolio positioning as the world adjusts to the new geopolitical and economic realities. Thank you very much for watching.